Hey there, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com, coming to you from Dubai. Had a fantastic week so far. Besides trying to adjust to the time zone here, it's 12 hours off of Seattle and Redmond, Washington. So it's a bit of an adjustment, but hanging in there and having some really good conversations already with investors and technical analysts from the Middle Eastern and Southeast Asian region. So it's very much a pleasure to bring you the show here remotely. Thanks for being flexible with us as we adjust the publishing schedule just a little bit to accommodate the time difference. But hope you guys are all doing well. And let's get to today's market recap. You know, as we're looking sort of a V-shaped performance to today's action when you're looking at the S&P 500, finished slightly higher, around 0.2%, we'll call it, to the upside. The NASDAQ composite up about 0.4%, pushing back above 16,000. Mid caps and small caps all up as well. Really interesting to me when I'm getting ready for the show, sort of going through a series of charts and reflecting on what I'm seeing. Small caps actually leading today, outperforming mid caps and small caps. Now, not by a ton, or large caps, not by a ton, but certainly a number. And we're actually going to look at the chart of the IWM and the Russell 2000 ETF in a little bit. It actually looks a lot more constructive than you might think. I've had in my head this idea of large over small, the mega caps working and other things not. When you look at the chart of the small cap ETF, it's actually not bad. It's actually quite good and arguably breaking out of a pretty significant base. That may be the most bullish piece of evidence I'm going to be able to share with you on the show today. The mega cap S&P 100 index just slightly higher, just above 2,400, and the VIX continuing to push down. Now, on yesterday's show, we looked at the chart of the VIX, talked about how lower volatility is sort of classic with that slow and steady uptrend kind of market. That is very much what we're seeing again today as we're looking at the evidence after the U.S. market close. V-shaped day today, as I mentioned. So, you know, the first half of the day really following the trajectory of yesterday's session. And so, pushing to the downside here Tuesday through about lunchtime, and then the afternoon, a nice steady incline, regaining the losses from earlier in the day, finishing slightly in the green for the S&P. Little mixed results here on the chart of interest rates. The 10-year Treasury yield pushing back right above 4.3%. The long bond yield up around 4.44. Short-term yields around 4.32. That's the 5-year yield, that is. And then short-term yields going down to the 3-month side, down around 5.25. So we still do have the inverted yield curve in the U.S. That's been the case for quite some time. Certainly has not, helped or hurt the growth trade at all, with growth stocks obviously continuing to work, but certainly something to keep an eye on. Rates higher for longer, usually not a great sign for growth stocks, but right now we have that sort of yin and yang, that push and pull between an AI-driven, growth-driven bull market phase and higher rates, which those are actually two incompatible themes, arguably. The growth trade working for now, and despite rates remaining fairly elevated relative to recent years, growth stock continuing to do just fine, of course. Looking at the commodity space, a lot of green here except for precious metals. So gold and silver down slightly, but not too bad of a day. Energy prices actually moving higher. The USO crude oil ETF about 1.5%, natural gas up about 3.5%, copper prices higher, gasoline prices higher, a lot of the soft commodities up as well. So the broader DBC, broader commodity ETF up about 0.8%, but you can see gold and silver slightly lower. Bitcoin continues to push to the upside. We're getting closer and closer to that 60,000 level, and it was not too long ago when we talked about really whether Bitcoin would ever get back to that level. At least that's what the chart was telling you. Now certainly pushing right past that. And I'm pushing slightly lower here, but we just sort of restarted the 24-hour session here by my clock. So right around 57,000. This is up from around 24 hours ago. We're down around 55,000. So it's been a nice push higher through the last 24 hours here. Looking at the 11 S&P sectors right here, you can see the utility sector at the top of the list. This is a bit of a head scratcher. While, the U.S. markets finished higher, a very defensive sector, arguably one of the most defensive sectors at the top of the list, with the XLU up almost 2% today. Communication services number 2, which was up 0.8%, followed by materials and consumer discretionary, both up about 1/3%. Only 2 of the 11 S&P sectors finished lower. Energy prices actually moved slightly downwards. The XLE was down 0.4%. That's despite crude oil prices actually moving higher today. And then healthcare stocks down about 0.25%. Let's go to our daily chart of the S&P 500, just kind of check in on where things are at. What you're going to notice is we're remaining above that trend line, that key green trend line that we've been highlighting. And again, I like to use trend lines as a simple gauge of trend, right? And, again, it's not the most perfect trading system. I wouldn't, probably run money based purely on a trend line. But for me, it ends up being a great visual representation of the pace of the move. And if you look, again, there's a little bit of a nuance depending on where exactly you draw these lines. I'm trying to line it up with the October low, the mid-January low, the late January low. You can see that lines up pretty well with the close here in mid-February. We did break below that trend line support a couple times last week and then gapped higher. I think that was on Thursday session of last week or Wednesday session. We gapped higher, and now over the last couple days, sort of pulling back a little bit, but overall, still remaining above that trend line support. And you can see with today's sell-off in the morning, rally in the close, we actually briefly touched that trend line support, but remained above there. So until we close below the trend line, I think it's a non-issue. That sort of tells you that we're sort of still within that overall uptrend phase. A close below that trend line, just like we saw here recently, it encourages me to revisit that as a potential area of support. Now, I threatened yesterday to actually update this Fibonacci retracement. I didn't do it. And so here, before your very eyes, we're going to update these levels. So this is basically saying, all right, we're taking the low from October. For now, this is the new high from just the last week, just above 5,100. There's our updated Fibonacci level. So you can see that the 38.2% level currently around 47.25. You can see that swing low from January around 4,700. And other support we would think about if the market would sell off through the remainder of this week. First level, I would argue, would be 49.50. That's the most recent swing low, right? Charles Dow Theory 101 says an uptrend is a pattern of higher highs and higher lows. So if you do get any sort of pullback, I always like to look to the left and see that last swing low. As long as we hold that, then that uptrend of higher highs and higher lows is still in place. That would mean we need to hold 49.50 on a pullback. Otherwise, that would bring that Dow Theory uptrend into question. Now, if we do break that, the 50-day moving average is next around 48.65. Then I would say you have this confluence of support around that 47 to 47.25 level. Longer term, it's the 200-day moving average. And Paul Tudor Jones famously said, nothing good happens below the 200-day moving average. So, price above an upward sloping 200-day moving average still long-term is quite strong. So I would say overall at this point, the trend in the S&P undeniably positive. I think if you're bearish here, it's despite the fact that the trend is still quite strong. My market trend model bullish on all three time frames. The momentum characteristics are quite constructive here, right? We're not overextended, we're not overbought, but the RSI has remained above 50. One potential warning sign here as we wrap up the chart of the S&P and then look at a bunch of other charts. Notice the potential bearish divergence. And I just say potential because I think you still want to monitor this. We'll see because we're still in an active uptrend, so it's hard to declare this a raging bearish divergence. But note the highs from early February to late February, the peaks in the RSI from early February to late February. Higher highs on lower momentum is a bearish momentum divergence. That has often been a pretty good measure of market tops. For now, it may actually be in place. I would need to see more of a breakdown in price to validate that high we saw a couple days ago was the high. I don't know if we can sort of declare that just yet, but something to keep an eye on to see if the S&P keeps threatening new highs, but the momentum is sloping downwards. That's often sort of a negative thing for a chart. Wanted to show you one other chart, really thinking about market breadth, and this is looking at what we call the newer Dow theory. Charles Dow's original work from the early 1900s, late 1800s, really dealt with the Dow Industrials and the Dow Railroads. So basically the producers of goods and the distributors of goods. A modernized version of what Charles Dow was trying to get at, in my opinion, is looking at the S&P 500 and the NASDAQ. So sort of the old economy names and the new economy names and seeing if they're in agreement. I like to use equal weighted versions of those two indexes, and I call that the newer Dow theory. So if the equal weighted S&P and the equal weighted NASDAQ are trending higher, conditions are pretty good because that means it's not just the mega cap stocks that are working, but because it's an equal weighted index, that means a lot of the other names sort of below those mega cap stocks are working as well. You can see from the chart, it's actually quite strong. The S&P, the equal weighted S&P that is, and the equal weighted NASDAQ 100 are both making a new high yet again this week. So long and strong, up and to the right, pretty consistent uptrend. The equal weighted indexes actually support the bullish phase that I would argue we're clearly in through today. I do want to look briefly at the chart of the IWM. And the reason why I want to show you this is because, I've sort of been very much reinforcing this narrative that the mega cap stocks are doing a lion's share of the gains. Small cap stocks have been lagging behind. And overall, that's true. And if you look at the relative performance of small caps, not that impressive compared to the S&P 500. But if you look at the chart of the IWM, which is the Russell 2000 ETF, you can see it's actually quite strong. Gapped higher today. And I mentioned the IWM or the small cap indexes outperformed large and mid caps today. And that's that gap that you're seeing here with the IWM finishing around 204. If you look to the left, you can see we're actually very close to making another new 52-week high. It actually touched this level right before the holiday season, sort of after the holiday season, right before the new year in late December. We pulled back to an ascending 50-day moving average. We bounced off of that ascending 50-day a number of times. Here in mid-February, we retested that high from late December. We pulled back to the 50-day yet again. Then we broke up, and I would say for now, we're very, very close to making a new 52-week high. So you can't really say that the Russell 2000 is not a strong chart when it's making a new 52-week high. That's a friendly reminder here. So you have the Russell 2000, the IWM, very close to making a new 52-week high. That's after a series of retests of an ascending 50-day moving average, all which confirms sort of the overall bullish phase. This takes us out of an 18-month basing pattern, right? This was the sell-off in small caps in the first half of 2022. You can see from mid-22, really now to early 2024, we've been in this basing pattern, right? Consistent resistance, consistent support. We bounced off of that support and actually briefly broke below that in October as the S&P and the NASDAQ were making their October lows. We then regained back to the highs and broke out of this basing pattern to the upside. Now potentially we're breaking out, and the momentum is not quite overbought, which suggests we could actually have much further to go. So I would say the small cap stock ETF, the Russell 2000, while the S&P, the NASDAQ arguably extended at these levels, the Russell 2000 very much not extended. An overall pretty constructive chart for now. Wanted to point that out to you. Another thing I wanted to highlight for you is high yield bonds. One of my guests, Ms. Schneider of Market Gauge, loves to talk about junk bonds or high yield bonds. And this is sort of an interesting part of the fixed income market because it's really a play on risk, right? Bond investors tend to be much more focused on risk assessment and avoiding risky scenarios because they're concerned about companies' ability to repay their debt obligation. That's why we look at high yield spreads, and that's why we look at the high yield ETF. The HYG is what we're looking at. JNK is another one. I wanted to point out that the high yield ETF reminds me a lot of stocks we've highlighted recently that had really good runs going into the end of last year and then a bit more sideways. If you look, the HYG has really been range bound from around 76 and a quarter, we'll call it, to around 77.50, 78 on the upper end. It's really been sideways. We're right around the 50-day moving average, which is now flattened. So overall, one of two things is going to happen here. Either we break out above 78 and high yield bonds give a major buy signal that makes a new 52-week high, or we pull back and break below 76, which would take us out of that basing pattern to the downside. If the market, the equity markets, that is, follow the traditional seasonal pattern of weakness in March, I would be looking at the HYG to see if this breaks down. And if it does, I would be very concerned about potential downside, not just for high yield bonds, but for other risk assets like equities. Important chart to watch. And of course, if it would break out, that would be a resounding buy signal overall. Just want to finish off talking briefly about Bitcoin before we look at some individual names and themes. The chart of Bitcoin continued to push higher. We highlighted this on the show yesterday, today, again pushing to the upside. As we mentioned on yesterday's show, we think the structure of Bitcoin still remains quite positive. Higher highs, higher lows. We are now nearing another big round number, 60,000. It's that blue horizontal line just above the vertical axis. That's the next level we're keying in on. After we cleared 50,000, which combined a Fibonacci level as well as a big round number, the 50K level, that also took us above the January highs. I would say for now, that chart remains quite strong. Full disclosure, I do own Bitcoin and Ethereum and the GBTC and accounts that I manage, just so you're aware. All right, let's finish off here looking at some other things. I want to just mention crude oil. Overall, at the upper end of the last 3-month range. So if you look, crude oil prices really have stabilized. I think of October, November, really into early December as a distribution phase. Lower highs, lower lows. This purple trend line sort of tracks that downtrend. Look how we broke out above that trend line in mid-January. Then we really had more of a consolidation phase. I'm labeling this as a coil pattern or a symmetrical triangle pattern. It ended up being not a perfect version of that because we kind of broke out, retested the pattern, and broke out yet again, but certainly a consolidation phase of some sort. We're now today closing back above the 200-day moving average. I think that could be an important thing to look for. If we break above $80 a barrel, that would really get us out of this bottoming pattern. Almost looks like an inverted head and shoulders, although it's not a very good one. So I don't want to label it that way because the head is sort of a not particularly well-formed head, but it is a bottoming pattern. We certainly made a higher low in January, another higher low in February, and now we're potentially breaking out. So crude oil above $80 a barrel, I think is an important level to look for as well. The RSI getting above 60 would validate that as a potential upside swing as well. Now, the reason why I want to point out the chart of crude oil is because oil services and other energy stocks have not been particularly strong. Here's the OIH, which is an oil services ETF here in the U.S. You can see the downtrend that we've been experiencing, lower highs, lower lows. But look at what's happened here in January into early February. We're really stabilized. The OIH has found support around 280. The RSI is just right around 60. The relative strength has been in a clear downtrend. I think the bull case from here will be, number one, crude oil prices break out. So I think you need to see crude oil get above $80 a barrel to really, think that this is even a real possibility. Then I would need to see OIH get above this swing high in January, get above the 200-day moving average, which means you really need to clear that 309, 310 level. The momentum would need to improve, so the RSI gets above 60. And if all those things happen, I would think the energy sector, and particularly the OIH, starts to be a relatively strong chart. For now, still a question mark until we can get that upside follow through. I do want to just finish off here our market recap, and then we will wrap our brief market recap show here from Dubai. I wanted to highlight biotechnology. We actually got a question to the final bar mailbag, maybe which we'll answer in our mailbag show at the end of this week. But I do want to highlight the IBB making a new 52-week high today. Now, Amgen was actually down today. So it's not all the biotech names that look particularly strong. AMGN actually gapping lower. But one of the benefits of something like an ETF or an index like the IBB, which is the iShares Biotech ETF, is it diversifies away from one stock like Amgen, and it gives more broader exposure to a particular space. So despite Amgen gapping down, you can see the IBB, the biotech ETF, up about 1.25% today. Really completing a rotation off of that low in October. We're breaking out above that January high. I'd love to see if we get follow through the remainder of this week and if IBB can hold 140. But overall, pretty constructive chart and getting above a well-established resistance level around 138 to 139. Let's see, where do we want to finish? I would say two other things that I would, two other charts to wrap up here. Home Depot, which overall has been one of my favorite charts to show just because it's a great example chart. And I think the bull case for stocks here would involve charts like Home Depot working despite the fact that they've showed bearish momentum divergences. I highlighted a potential bearish momentum divergence earlier in the show. Home Depot is a perfect example of that. You look at the highs in December, January, February, the momentum sloping downwards, actually making new price highs on weaker momentum all through that month. But this week, Home Depot is actually making a new 52-week high, and the RSI is once again overbought. I think when you see that sort of price action after the price gap last week, I think that sort of invalidates that bearish momentum divergence. At this point, I don't think you can say it's a valid conclusion here. I think that's been negated by price action remaining quite strong. Now, it's moving higher today, really in sympathy with Lowe's, which was one of the earnings reports before the open today. Nice up move in Lowe's, and Home Depot moving up in sympathy, up about 1.1%. But I think overall, sort of negating that bearish momentum divergence, probably one of the more constructive technical developments I can highlight for you here today. That's our briefer market recap show here from Dubai. I want to wrap up with the 3 in 3, three charts in 3 minutes that tell the story of this market environment. Here is chart number one. We mentioned in our market recap the newer Dow theory. Again, I would say when in doubt, keep it simple. Focus on the equal-weighted S&P, the equal-weighted NASDAQ. These are both making new 52-week highs again this week. it is really hard to be bearish, and I have to remind myself, how bearish do you want to be when the equal weighted S&P is making a new 52-week high? That means it's not just the Amazon, Netflix, Nvidia, Microsoft, Amazon, Apple sort of trade that is working. It's the everything trade, right? It's the equal weighted index that's actually doing quite well. Equal weighted NASDAQ making new highs at the same time. So I think overall, the markets remain strong in terms of U.S. equities as long as those two equal weighted indexes continue to go higher. Chart number 2, looking at crude oil prices. I'm excited later today here in the Middle East to have a discussion with a group of experts on crude oil prices, the energy space, oil and gas industry. We're going to talk about crude oil, which overall has not particularly moved higher despite a lot of geopolitical risks and a lot of instability in oil-producing regions. Overall, I think crude oil above $80 a share is a pretty constructive technical chart. I'm looking at the bottom at the relative strength of the energy sector versus the SPY. One of the reasons why crude oil prices are so important is because look how closely these two series match, right? So the relative performance of energy is very much driven by crude oil prices. A breakout in crude oil most likely means energy, which has been a lagging sector over the last 6 months, really may start to improve. And that could be an opportunity if you've been underweight the energy space so far. Finally, we want to highlight Virgin Galactic SPCE. I can't tell you how few questions I've gotten about Virgin Galactic. When it was going up and to the right, we got questions about this a lot. Same with solar stocks, other renewable energy names that did quite well in a previous market cycle, but have been struggling quite a bit recently. If you look here in February, lower lows in price, higher lows in momentum, reminds me very much of the October low, where you saw lower lows in price, higher lows in momentum. That's a bullish momentum divergence, usually suggests further upside to be had. I'd be excited if Virgin Galactic can get back above the December high, back above the 200-day moving average. Until then, I think it's still quite a speculative chart for now. That's it for today. Thanks so much for joining me every weekday after the close, and thanks for a little flexibility this week as we try to bring you a show every day from Dubai. Look forward to sharing a lot of constructive conversations I've had with technical analysis experts here in Dubai from around the world. And until then, be well, stay safe, have a great night.